Good evening, everyone. We're here to present our valuation on Marley Beverage Company, and here is our team. Would you like to introduce yourself a little bit?
I'm Conrad Alex Herman.
Harry Cross Jr.
Weston Lackey, Nathan Wade,
And I'm Mateo Zapata.
Dorothy Zhou.
Okay, so Marley Beverage Company. A little bit of background. They started in 2009 with actually a partnership with the Marley family with this idea of creating beverages that are healthy and kind of follow Bob Marley's kind of persona. And they do prepackaged and ready-to-drink beverages. They have, we'll go over the products in a second, but they do anything in the cans, so coffee and teas, etc. And they compete in a giant industry with Coke, Starbucks, Monster, Dr. Pepper, to say a few. But they almost compete with those guys as subsidiaries, the smaller companies under them. So products, they have basically drinks for pick me up or put me down. These are the relaxation drinks, those are the teas, the mates which will pick you up, and then the canned coffees as well. So they were bought in June of 2017 by New Age, which is the logo in the top right. Traded on the NASDAQ with the CEO, Brent Willis. He has spent time with Coke and Kraft and has been in the industry for a long time. Here are some other companies New Age also owns: Coca Libre, Zing Tea, and it's all the same industry, the healthy, ready-to-drink beverages. And then Terry, this one's...
So we were fortunate to, in addition to the financial statements that came through from Deal Stats, to stumble upon the, because the company was bought, 8K information from the acquiring company, NBEV. They had filed 8Ks that included previous year's financials. And they initially looked really, really grim, which I think ultimately becomes kind of the basis for our valuation. If you're a prospective buyer of a company like Marley's, you have to have some sort of best owner premium, otherwise this company's not going to be worth anything to you. To illustrate that, the operating expense to revenue ratio for year 2015 and 2016 were 91% and 108% respectively. I mean, in short, if you don't have some kind of best owner situation where you can take those and just annihilate them, this company is never going to make any money for you. So we had to kind of figure out what an appropriate ratio for a company like this would look like, and that's in our comp analysis. We came up with a 29.37, and that'll appear later in the valuation, that we use to contribute to our perspective on acquiring this company. Some other things that kind of stood out in the balance sheet. Current liabilities were pretty frightening. 2015, 16, and 17, 39.5 million, 47 million, 49 million. This company is not making enough money to pay their current liabilities. We actually found out that, my language might be wrong here, the only people that they are indebted to is a company called Viva Beverages, who were the initial investors in this company, and they had an initial offer of like $1 million when Marley was first founded. That included, I'm guessing, some kind of language that allowed for additional money to be borrowed from Viva at 12% interest. So ultimately, I think the takeaway is Marley's not generating enough revenue to meet their current liabilities, which is a huge problem. And also worth noting were the accounts receivables, 18.5, 19.8, 21 million essentially, massive accounts receivables that just keep growing, are all historical financial data that we took into consideration for our valuation. So.
So as we mentioned, this company, Marley Beverage, was acquired by New Age Beverage Company, which is a public company in 2017. And we could find, because it's a public company, we could find some information about how this New Age Beverage Company is making assumptions about what they were going to acquire, sorry about that. So this is our per acquisition assumptions, which all has a source backup from the New Age Beverage Company info. First of all, the gross revenue of 15 million, that's from their annual 10K before they acquired the company. The gross revenue, we put the information on there because New Age was making an assumption that we're going to acquire this company only on a contingent, which is what we use in the financial world, an earn-out, that if the company meet the requirement, that they will generate gross revenue of 15 million in the next year. So that's where our assumption comes from. And the second one, which is the sales expansion of $10 million, that's from the conference call scripts from New Age Beverage Company, that they are saying because we have Marley and we're putting money into we're marketing this Marley beverage and all their products, and they are expecting to sell them in 10,000 stores nationwide, and which with each store they will generate revenue of 1,000 per store.
And that was, if I may add, that was only one of the 3 major products with under Marley Beverage.
Yes, so with other products, there is more than that. So that's the worst assumption of their sales expansion. And the gross margin is also what they're making in the conference call to the investors, that they are expecting Marley and all their products to have a gross margin of 48%. And operating expense, this is a very interesting one because pre-acquisition, Marley has a very large amount of operating expense, but because New Age came in and was going to acquire this company, with New Age, with its size, Marley could basically eliminate all of their operating expense because they have a huge backup from the New Age Beverage Company that they can use their manufacturing, their human labor, and all that all that expenses that go under this category. So, and we can also find that in their press releases. That's from the acquirer of this company.
Cool. So Harry kind of ran through some of the historical finances of what's going on with this company, and then Dorothy also took the liberty of doing a micro-analysis on where we get our information. Now we talk about the technicals and how we go about projecting our financials. So just a little bit of background, like going from what we discussed before, this company and historics, you see like it's making like 10 million, 9 million, then all of a sudden it drops down to 1 million, right? This is why we were able to kind of talk about a growth rate that's relatively higher, because we know that this company got acquired at a certain point in time, and per terms of the agreement of the agreement of transaction, Marley Beverage Company had to at least make 15 mil trailing 12 months in order for the company to be bought out. So we used that as our 2017 base year, and we also outsourced, and we were fortunate to get this figure that said the beverage and soft drink industry will be growing at a 4.1 growth %. So we were able to just fix that, and up until our end year of 2020.
I think just if I can add as well, that 4.1% was really specific to the non-alcoholic organic beverage industry. So we kind of fine-tuned, and on a growth rate we were comfortable with.
Correct, and absolutely. Yeah, so that kind of gave us a better estimation of at least this is like kind of the minimum, this is kind of what we expect to get. We ran off it, and then we got a lot of our information from the internal books from the 10K from what New Age posted and then Marley posted. And then you can see here that we have a fixed gross margin of 48%, that was also mentioned. So we can have about 7.2 million, and we kind of said that because of synergies, that they would have no operating expense when their operating expenses were really high. And like again, the story behind that is that because Marley was operating with so many employees and management that deemed unnecessary, so once the acquiring company bought them out, they were able to gain better economies of scale because more efficiency, better management, things of that nature. And then we move on to depreciation and expenses. One thing to note about that is it was kind of difficult for us to be able to say how we go about this, but we said since there's a percentage of Marley's assets are now New Age's assets, so we just took a ratio behind that and then multiplied it by the amount of depreciation that New Age currently owns. And then what else? Operating income, other net income, and then interest expense. We just did a basic revenue forecast or interest expense forecast of interest expense over total revenue and just fix that long term.
I think I want to step in here, and I think this is going to be a little bit of a flaw in our presentation. However, we didn't actually assume no operating expenses. We did assume in our final free cash flow. Our final free cash flow, we assumed that our operating expenses were going to be reduced due to the fact that New Age Beverage Company acquired this company. So what we went out and did is we did some research on New Age itself and some private comparables as well as public comparables to see, you know, you're making a beverage, right? So what are your costs? You've got labor, and that's your cost going into it, right? And so we found an average in terms of operating expenses to revenue for about 5 companies, and that came to the 29% that he was talking about. So what we did was we took that 29% and we didn't actually put the 29% to the 15 million. Did we put the 29% to the 15 million? I think we applied it as a ratio of their total assets.
We did, yeah.
Correct me if I'm wrong. So what we did was, okay, so New Age has got this 29%, on average, the beverage industry has a 29% operating expense to revenue ratio. So what we did was we said, New Age as a entire company, because this valuation is post-acquisition, unlike the valuation we just listened to. So what we did was we said, we're going to look at New Age's post-acquisition 2017 year-end, which is post-acquisition total assets, and at the same period of time, we looked at Marley Beverage Company's total assets. That gave us a ratio. And then we applied the ratio, I guess, of total assets, or we used that same ratio to apply operating expenses to what proportion was to this company. And that's what actually drove our free cash flow. It wasn't nothing.
Right.
So I think this was an error in our slide, I think.
Yeah.
I'll think for more numbers.
So I'm going to talk about the balance sheet and how we projected the years going forward for the balance sheet. To keep things straightforward, we made the assumption that the balance sheet numbers are going to remain fairly similar. So what we did is we did a basic trend analysis, taking the ratio of pretty much everything to total current assets and saying what percentage it is to that over the past 3 years, looking at that and saying weighting them the most recent year at 50%, the second most recent year at 35%, and the third most recent year at 15% to give us an estimation for the next year, when we just did that for the next 5 years. And another thing to note in the balance sheet is we took out the long-term debt as well as the accounts receivable. We took out the accounts receivable because we figured after acquisition, New Age was able to pretty much ramp things up and was able to cash in what they we're going to receive. And so now Dorothy's going to continue with the free cash flow calculation.
So this free cash flow calculation is very, just took a traditional approach. We take the revenue, EBIT and minus tax, which we get the, and from there we get the tax adjusted EBIT. And there we add back in the depreciation and amortization expense and minus the change in operating working capital, where we took the difference between current assets and current liability and see how the changes were over the past couple of years. And then we minus the capital expense, which is the difference between fixed assets of years and add back in the depreciation. And here is our free cash flow results. And we use that for our final valuation models.
Do you want to touch on this, Wes?
Yeah, I can. So, I guess the valuations that we looked at was solely the market valuations, and we ran a couple of scenarios, and the scenarios that we found most applicable. Did we have a slide that looked at the private company comparables where we drove these multiples? No. Okay. Well, we gathered a list of private comparables, and we refined the list from just beverage industry comparables, food and beverage industry, to more specifically niche beverage products, and we used a revenue multiple as well as our exit multiple in the continuing period. And we did that because in our historical financials we were a pre-profit company, and we did want to put some weight on the free cash flow valuation, or on the forward market multiple valuation, because this company really is driven by the revenue and the products they sell and the inventory they turn over. So the valuations that we weighted, I think we can speak a little bit to the 22%. I don't necessarily like that we called it whack in this scenario. I think we have some fine tuning to do on our slides for sure. But really what this was a required return that we assumed, and Harry actually said, you know what, my Transamerica retirement account, I'm getting 22% right now. And so if I'm going to invest in a company like this, that's got to be the bare minimum of what I should be able to make, especially knowing that you're investing in a company that's essentially a sinking ship, looking at their historical financials. And so we created a matrix of valuations, and we used a 3 times exit multiple and a 3.5 times. And then we also ran another valuation where I think the 11.8% was New Wage's, was it the cost of capital data?
It was a whack, yeah.
Yeah.
It was whack.
Oh, so it actually wasn't.
So it was
the whack.
Bloomberg, yeah, that was
This,
Bloomberg
I think this
metric.
should be a required return, and this should be whack, but
Yeah.
this was the whack. So we ran,
A matrix.
we ran a valuation matrix, in total probably 16 valuations, or 8 valuations at least, and essentially just weighted these all at 25% to drive a $46 million valuation.